Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us as you do each and every week, listening to us on KCAA. That's AM and FM radio out in the Inland Empire, San Bernardino, and Riverside counties. Our favorite places to be, especially this time of year when it's spring, it's beautiful. Although the Santa Ana is kicking up, looks like we might have some super winds affecting a lot of what we do either on the weekends or in the next few days. I know when you get out to view a house, when you go out to look at a house to buy or rent or whatever you want to do, it's the hardest when it's raining, obviously. Second hardest for me is when it's really windy. I hate the wind. It just always makes me sneeze, makes me feel terrible. And it's kind of like the way market is right now. I mean, it is not a terrific market, but it's not a bad market. Now, what do I mean by that? Well, the amount of properties on the market since 19 have really been poor, but we have picked up the number of houses on the market over the last 2 to 3 weeks, even in the last 2 to 3 months, maybe the first of the year. Now, it's not great, it's not awesome, but we do have some new houses, especially up to 15, as everybody knows, so you can go out there and see what they are and price them out and see if you want to buy that sort of thing. The market in the mortgage end of the business, well, we were above 7. We were drifting up towards 7.5 for a while there, and now we're down below 7. We've seen mortgage applications really on the upswing both last week and this week. Now, is it like it was in 2019, 2018? No. But is it better than it was, 6 months, a year ago when we were looking at 7.5% interest rates, 8% interest rates? Yeah, it's better than that. So like I say, like the Santa Ana winds that affect me and my health and how I'm breathing, the market is kind of like that right now. Maybe you're feeling it, maybe you aren't feeling it. If you are feeling it and you want to have some place to vent, you can always come to me. I'm on YouTube, Jeff Barton, the Mortgage Voice. That's where you can see the show, archive the show. We have many of them there, hundreds of them. You can see what's happening this week, what I thought about last week, and you can make your comments. You can express your desires and willingness to either buy into what I'm saying or come up with your own theories. But this is a good place to start because nobody on the radio is given a show like this, especially out here in the IE, one of the favorite places that we've been with KCAA for years, for a decade almost. So thank you very much for tuning in. If you also, want to go to the website, it's themortgagevoice.com. There you can see some of the people that come on the show each and every week. You can look at them a little bit more in depth, see their pictures, contact them directly, and be able to actually get out there and contact them directly. We try to get a larger, big, huge, universal view from me sitting here talking to you on a couple of segments. Then we get into the local knowledge, the people that have programs, the ability to be able to see around the corner to what your needs might be, some of the new surprising programs that are out there. I know you're all heard of that new DPA program, which is forgivable. And also the 1, 2, 3 buy downs that are out there. There are a number of different programs that'll help you be able to purchase the house you want to be able to do. Let's get right to it. News to use section. The 30-year fixed rate loans are at 6.94%, 15 years at 6.46%. The FHA product is at 6.44, and the jumbo is at 7.25. 2 years at 4.62, and the 10 years at 4.19. As you can see, this gap that we've been talking about, oh my gosh, it must be for years now, where the 2 is actually higher yielding more than the 10. Used to be in the reverse, and if it is like this in a traditional sense, it always foretold that we were going into a recession. Now, we've been, as I say, in the inverted yield curve for 2 years. And I read an article, finally somebody wrote it. I saw it on Yahoo. I think you can go there today and see it. It basically outlined the fact that this inverted yield curve means zilch, zep, zada, nada, whatever you want to say. It doesn't really mean anything anymore because, as I just said, 2 years in the inverted yield curve, and we are not in a recession, and it doesn't look like we're going into a recession. We see the earmarks of many positive signs in the economy, whether it's your employment data, even the inflation data, which came out on Tuesday this week. as most people realize, inflation is around for a while, because what we've had in this post-pandemic world, where we were flush with cash for a long time and still are in many respects. They passed that $1 trillion infrastructure bill, and that's going to be paying dividends for a decade at least. And certainly we had everybody getting money, $1,200 checks, plus a lot of companies that were able to apply for the PPP loans, which allowed them not to have to pay their employees, had the government pay it for a while, whatever it was. Some people got a few bucks, some people got a lot of bucks. However that is, that money has been boosting inflation, and everybody points to it as the major reason. Of course, now in hindsight, nobody seems to say that, hey, you know what, we needed to do this. We had people who couldn't work. We had people who were told to stay home. We had businesses. We had pandemic. We had a million people dying. We had a lot of things going on. The government did step in, did what they could, and that's why we have inflation. I guess some of that's true. I've been the proponent that corporate inflation has really been more at the center of the last year's worth of inflation. Certainly the amount of money that was invested in people rather than banks, like it was in 2008, has allowed people to come back to life. But again, the way that we look at inflation is we look at it as somehow a government giveaway that caused inflation, is now everybody's mad at. Well, had you not received this money, the same complaints that we heard in 2008 we would have heard again, i.e. you give money to the corporations, but what about us, the people? Who's bailing us out? Well, they did the reverse this time. It worked. The economy's roaring. The only thing that the problem is that inflation is still stubborn, 3.1, 3.2%. It did the core inflation of shelter, and gasoline prices went up. Now, the gasoline prices I've talked about ad nauseum here on the show. I'm just of the belief that the United States of America has a problem, that the oil companies and the gasoline people and whoever delivers you gas is charging too much money. I read today that the United States is pumping over 15 million barrels of oil a day. And in California, we pump our own oil. Matter of fact, we refine our own oil. So why is it that we have transportation costs? Why is it that we have all these other costs that are added into a gallon of gas? I'm a proponent of eliminating the gas tax. Yes, it would eliminate a lot of social programs, but the trade-off is that I, in St. Louis 4 weeks ago, was paying $2.50 a gallon of gas. That's right, $2.50. Well, out here we're paying, how much are we paying? Darryl, do you know? $5-6, something like that? At least that, right? How's your mic today? Oh, so okay, very good.
It's a longer reach for me.
Okay, well, regardless, gas.
We're working on it. Yeah, gas is about $4.30 a gallon.
Not here in L.A. No way.
Well, we're in Ventura County. You're in Ventura County.
Sorry, in Ventura County, it's not $4.30. It's I beg to differ. Anyway, regardless, if it's out there in the IE, are you paying $5? You're paying $4.50. It's certainly $1.50 to $2 more than they're paying anywhere else in the country. One of the reasons is that California derives most of its tax dollars on a daily basis from the gas, and that gas that you buy every day, every week, that you still have to, I'm filling up my hybrid twice a week. Now, I don't drive all that much anymore, as you all know. I sold one of the companies that I used to work for on a daily basis, so I don't drive 70 miles a day anymore. I might drive 10, maybe 20, but still, twice a week on my hybrid, yeah, that's a lot. And I think that particular facet of what we have here in California needs to be fixed. Certainly, there are many ways that we can look at taxation, about what the money is being used for, but that particular piece of the puzzle could really solve some issues here. We figured it out last week, 2,000 gallons a year. If you're paying $1.50 per, in terms of tax, it's about $4,000 a year. Now, what does $4,000 mean? It means that that down payment on an FHA loan is that much less on these DPAs, on the what is it, 97%? Yeah, 96.5% is an FHA loan. That 3.5%, well, you figure it out. I mean, obviously, if you're paying upwards to $10,000 or such on that down payment, and you come in with $4,000 that you don't have to pay in gas taxes, well, that's a big deal, and it's a big deal for a lot of people, more than people realize. I know that we're all kind of spoiled with the fact that we live a pretty good lifestyle here in the U.S., but if you go outside the U.S. or even in some communities that are struggling economically, $4,000 a month would really help, and it would help either, as I said, in the down payment of the house or however you invest that money and do the best you can. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Appreciate you listening to me go on and on here, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us on a weekly basis. If you do, you're driving around right now on a Saturday or Sunday, doing your weekend thing, hardware store, church. There's certainly any number of other things you might be doing if you're listening to the Mortgage Voice, and I'm Jeff Barton. So I appreciate you spending a few minutes with us. We usually talk about what's happening in the rates. We usually talk about what's going on in the real estate market. We certainly love our IE Inland Empire people, San Bernardino, Riverside, as I say, and KCAA.com is our affiliate radio station, and you can go to, as I said, KCAA.com to listen to what we do. They archive our show all the time. We also do it on YouTube, Jeff Barton, the Mortgage Voice, and we have a number of podcasts that we're also on. Daryl, do you have that?
Sure do, Jeff. We're on Apple Podcasts, Google Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Audacity, YouTube, Podclips.io, and themortgagevoice.com.
I don't know Audacity. What is that?
It's there.
It's one of the podcasting places that you can not only hear this show, but tune in, say you like what we're doing, try to get involved. If you want to get involved, you can always contact me directly through YouTube or through the website, which is themortgagevoice.com. I am Jeff Barton, and this is The Mortgage Voice, and again, thanks for listening up. Okay, a little bit more news to use section. Inflation. Yes, the inflation report came out. The CPI was up a tick, as we talked about a little bit earlier in the show. What does that mean? It just means that, as always, things don't go according to plan. We were hoping that we were going to get not only inflation down to 2% very early in the year, but also be able to have the Fed lower their interest rate. Now, tangentially, yes, not exactly, but tangentially, if the Fed lowers rate, quite often the mortgage rates follow. Usually what happens when the Fed lowers their rate, the actual securities that they buy and sell are cheaper. Therefore, the mortgage insurers also go, the mortgage-backed securities, rather, also go lower. And the reason is that competition in the marketplace breeds the fact that, hey, if I can buy something over here and get a yield pretty good, and it doesn't cost me as what I'm paying over there, then that means that the mortgage rates have to come down in order to be more attractive, in order to have more people come to them and buy those mortgage-backed securities. That may be confusing to you, but here, let me confuse you a little bit more. Usually when we see the Fed drop rates, we see a lot of things going on in the economy, and one of the good things that we see is your credit card bill will also go down. It doesn't follow exactly, but it means that, yes, the interest rate they charge on credit goes down. That's a good thing. The interest rates they charge on your car loan goes down. That's also a good thing. These two things are adjustable. It's not like a fixed rate 30-year mortgage. It doesn't work like that in most financing. Most financing is tied to whatever the current Fed rate is plus whatever the margin is to get to whatever the rate that they're charging you. On credit cards right now, if you are holding a balance above 30%, you're going to probably be paying about 22% on your credit cards. That's right, 22%. Good reason not to get above 30% if, in fact, Fed lowers the rate, the 22% will also come down. It doesn't cost them much to borrow money in order to give to you or pay your vendors because you're buying on credit. When we talk about credit, when we talk about buying on credit cards, we always say no more than 30%. If you got a $1,000 limit, no more than $300. The reason is it affects your credit. Why does that matter? Because your credit score is the number one reason why you get a higher interest rate on your mortgage loan other than the going rate. The going rate today, as I said, 30-year fixed rate is 6.94. Hopefully we'll see that fall some more. We were above 7%, about 7.25. Last summer we were almost up to 8%. So this has come down, and it's slowly but surely going to continue to come down. We talked about it earlier in an earlier segment. Okay, the spread between what is owed and the value. Okay, this is a topic that we talk about when we talk about why the real estate market is frozen, what they call the lock-in rate, why that is, and why it may be softening. When we say softening, what we mean is people during the, latter half of last year weren't going anywhere, even the beginning of last year. Why? Because 3%, 4%, 5% interest rates on loans are pretty sweet. They're not around anymore, probably won't be around for some time. But if you are one of the people who got a loan like that, the chances of you wanting to get out of that loan and into something else was less. You're fresh. You're hearing these crazy rates at 8%, 7.5%. I don't want to do that. I don't want to sell my house and move. Even if you want to, even if you need to, even if you're older and you can't really climb stairs anymore, even if you just want to downsize your house, even if you want to get out of that condo and buy a single-family home at 7.5%. Maybe you could do that, but getting out of that loan, it's really a tough situation. Maybe softening. We're seeing some of the numbers. One of the numbers that I talked about earlier in the show was that mortgage applications are up. They're up last week. They're up this week. Now, why is that? Well, we have seen, you're right, we have seen mortgage interest rates come down a little bit, but we are seeing a softening in those people who said, never, I will never get out of my 3% mortgage. Okay, so the reason being is why? Why are they doing that? Now, one of the reasons is they need the money. I mean, let's face it, if you're sitting on equity in your property right now, and your equity went up 35 to 40% over the last 3 years, doesn't it make sense if you're going to get into another property and you want the same mortgage payment you're currently paying to put more down payment? Heck, you made it up in the equity you already bought. And you already have in your mortgage. So if you've got, 50% equity and you got to put more than 20% down in order to get the same payment, at 7% that you're getting at 3 or 4%, really kind of pays because you're really buying equity. You go into a situation, putting that much money down, paying that much less in terms of the total amount of money that you owe. You could even get into a 15-year if you wanted to be, clever about it. The 15-year is about a half point less than the 30-year. Anyway, that's one of the reasons why I think there is a softening in that lockup rate. A couple of the figures that I want to get to, 22% of the loans are under 3% in the market, 22%. Okay, it doesn't sound like a lot, right? 59.4% are below 4%. Okay, that's 60% of the loans are below 4%. We're not going to sniff 4% for my lifetime again. And then 78.7% are below 5%. Now, 5% we may hit. That's true. It may happen. It's not going to happen in the next couple of years, but it might happen. Just depends on where we are in terms of the economy. Obviously, the economy is roaring along as we go into the last month of the first quarter of 2024, and we have seen no signs of a slowdown. That's one of the reasons why the Fed is probably not going to lower their interest rate until mid-June. I'm reading all over the place. They were saying March, then they were saying May, now it's June. The reason for that is obviously inflation, but also you don't need to. There's no reason to rush into that. Now, obviously, for people who are trying to buy a house and people who obviously have 22% on their credit cards, they want to see the lower payments, absolutely, and I get it. I really do get it. But if, in fact, it is a healthier economy overall, if we keep interest rates exactly where they are, what was the slogan? Higher for longer? I think that was the slogan for the longest time. During the last year and a half, when we saw mortgage interest rates from the Fed, not mortgage interest rates, the Fed borrowing rate, Fed interest rate, keep climbing, 5.25%, 5.75%. That's what it is now. And they said, yep, that's what we're going to do. We're going to do higher for longer in order to tame inflation. Well, since we don't have the mass layoffs that we were predicting, although Larry Summers still talks about that, although he has really backed off. As I said, 3 or 4 weeks ago, Larry Summers, he's at Harvard University, used to be in the Clinton administration in terms of their Clinton or was it Bush? It was one of those one of those presidents. It's hard to get them straight because they just keep rolling along. The economy seems to be on its own course with very little input or help from the president, other than hey, let's print some more money, which seems to be everybody's problem the last 4 presidents. Regardless, what I'm saying about Larry Summers is he too is saying that the recession is probably in the rearview mirror. We won't be seeing it, but he does caution about layoffs in large numbers, simply because that's the nature of where we are in the economic cycle. Okay, places most likely to fall real estate-wise in 2024. Got about 30 seconds. Ogden, Utah, Ocala, Florida, Salt Lake City, SLC, Utah, Palm Bay, Melbourne, Florida, and Spokane, Washington. Now, I don't know 2 out of 3 of those places, but a couple of them I do. Nice places to live, sound like cheaper. And when I say fall in prices, we're talking less than 1%. So real estate market seems to be chugging along. I'm Jeff Barton, your voice in the mortgage industry. Thanks for listening, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening to us on a weekly basis there at KCAA out in the Inland Empire. Appreciate those people who are loyal, listening to the show each and every week. We try to bring to you relevant information that you can use or either ponder. I know many people, especially in a market like this where you see rates going up a lot and then coming back down a lot, they're waiting for the perfect time. Excuse me, we've had on this show many people who say, look, there is no perfect time. Best thing to do is try to get into a market and then refi if the rates go down. I don't know what the best strategy for you is. That's why we bring great people on the show, because they know way more than I do, and I appreciate their not only their expertise, but their time that they give us coming on the show to talk to you all. One of these people is Adam Potafy. He's from Logan Financial, and he joins us now. Adam, how are you?
I'm doing great. Thanks, Jeff, for having me.
Great. Can you hear me?
Yes, sir. I can hear you well.
Okay, excellent. Very much. All right. So talk to us a little bit about market conditions and what you see going forward. I guess when we talk market conditions, we talk about rates. We talk about the new programs coming to the market. How are you helping buyers? Things like that.
Yeah. So here at, and I think you referenced us as Urban Financial, and that is our former name. So we were renamed to Finance America Reverse, and then technically we're now the parent company of AAG, which is the American Advisors Group.
Of
so this
course.
Is Tom Selleck TV commercials that you see. So we are the parent company for them. So we are Finance America Reverse, and we specialize essentially in home equity products for seniors specifically. So how do we help seniors leverage the equity that they have, the equity that they're sitting on, to maybe live a more freed retirement? So one of the products, well, the most recent product that we have that hit the market competes head-to-head with the HELOC.
Right.
So you want to think of this Home Safe Second as a HELOC alternative, because what it does is it's essentially an optional payment HELOC. The big distinction, well, one distinction between our product and the HELOC in the general public is the fact that our product is a fixed rate and it is a lump sum. So that means it's not truly a line of credit that's available for the borrower for the future. It's more so designed for someone who needs additional liquidity today. They're sitting comfortably on that 2, 3, 4% interest rate forward conventional mortgage, but they just find themselves in a pinch. And if they're 55 or older, they can qualify for this product that allows them that additional liquidity, extract that additional equity from your property without necessarily making payments. You can make the payments because such is the nature of reverse mortgages. Payments are always welcome. And this is, by the way, a form of reverse mortgage. It's designed for seniors 55 and older to essentially have a shot at something a little bit different that is otherwise unavailable for the general public at large.
Right, exactly. Okay, so credit requirements on this, are there any, or is it just about does the property qualify?
It's both.
Okay.
So the And I think what sparked this conversation to begin with, when I got your invite, Jeff, is when we put out our new bulletin on the stated income docs approach
Right.
with this product. So this is for borrowers with scores 720 and higher. We're not looking at any income at all. Literally, stated income is all there is to it. The only thing we're paying attention to there is their payment history. Like, how do they qualify for the stated income after their scores are 720? There has to be no late in the prior 2 years.
Okay.
So 24-month payment history should be perfect. And if that's the case, and if they have at least 5 years remaining on the existing mortgage, then they qualify for this stated income approach. Now, someone whose scores are below 720 doesn't disqualify them for the product. Simply means we have to take a different financial assessment approach. So this is where we more thoroughly have to assess their income, offset it with the expenses that they have coming in, meet the residual income requirements that are standard in the reverse mortgage space, essentially. And for scores under 600, this is where they disqualify for the product. So there's 3 buckets. Less than 600 disqualify. Between 6 and 720, we do a full financial assessment approach. And 720 and up, easy peasy.
Okay, excellent. And the loan limit that you have, is there a loan limit? I mean, is it up to a certain percentage of the property? I know it is, but could you explain that again?
Yes. So the loan limit technically goes up to $4 million. So This product was originally designed as a jumbo, meant to target home values $1 million and up.
Okay.
I think with a lot of the improvements to the product, we've been able to reduce the minimum value requirements, minimum loan requirements, I should say. And that minimum at this point is literally just $50,000. So that means that we literally lend from $50,000 to $4 million. And LTVs are driven by 2 things. It's the approach is a little nuanced, but it's essentially, and I'll do my best to kind of help this land.
Yeah. Okay. That's good.
Yeah. The LTV is going to be the lower of the current reverse mortgage LTV in the marketplace plus 10%, or the existing liens LTV plus 25%. And, I don't want to complicate this for anybody, but just know that the LTV isn't so linear. It's not a kind of one size fits all. So for a quick quote, all we ever need is home value, mortgage, the lien balance on the first, date of birth, zip code, just 4 things.
Is this like a subordinated type loan?
Exactly right.
Okay.
Exactly right. Second lien position, and that's why we called it so cleverly.
Right.
The home safe second.
Right, exactly. Well, most people don't realize that when they get a loan like this, that it stands behind the first loan, which is primary position. Do they need to have also the first loan with your company? Like, can they do it with a reverse and then go about getting a reverse second with you as well?
That's a good question. So the answer is no. So this is designed for someone who's sitting in a conventional forward mortgage. So you couldn't put a reverse behind a reverse. You would just refinance the existing reverse to begin with, if this is something you were looking to do.
Well, how is the secondary market on these types of loans in terms of purchasing? Now, I know you guys are a pretty big company, have a lot of money. We're always worried about what happens in the secondary market just because of the way the volatility is, the way jumbos have really been snuffed out of the marketplace because of the low jumbo rate that they were getting during the pandemic. Now nobody wants to do a jumbo, so jumbo rates are hugely expensive. So how are you guys backed? How are you funded?
Yeah, well, so Blackstone actually is one of our largest investors.
Okay.
So the deep pockets in many ways are because of them, but there's, of course, other avenues. And as far as like the appetite from the secondary standpoint, to be honest, I don't get to peek behind the curtain in that regard. So I can't intelligently comment on that. I wish I could.
No, that's fine. The reason I ask, and I ask a lot of different types of questions like that, just simply because people like to know that who they're borrowing from are strong financially, right? If you go to Wells Fargo, Bank of America, City Chase, which nobody goes to for loans. But if they did, they would know that, oh, these are big banks. I know who they are. Finance of America, been around a long time, good company. I totally get that. I just always like to know who's got the money and where is it coming from.
I got you. And we went public a good year ago or so, right before, or was it right after we purchased American Advisors Group? But so at the end of the day, we are now a publicly traded company, so that certainly helps us too.
Absolutely. Okay, we are up against it. Can you let people know how they might be able to get in touch with you? You got a great product here, and I want to make sure that everybody can get it to you as soon as possible if they want.
Yeah, no, I appreciate that, Jeff.
Sure.
Yeah, no, to reach me, it's literally as simple as just emailing me, and it's Adam@FAR. That's for Finance America Reverse. Adam@FAR.com.
Well, simple is better, right? I mean, that's a great email right there. That makes it pretty easy to get a hold of you. So I appreciate that, Adam, and thanks again for coming on the show. It's always great to hear from you.
Pleasure getting on here. So I really appreciate you having me once again.
Great, and thank you very much. We'll see you next time. Thank you.
Very good.
Okay,
Bye-bye.
great. That's Adam Potafy from Finance America Reverse. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, and thank you very much for tuning in, listening to us, making us the #1 radio station in your hearts and my mind, and I really appreciate that. KCAA is our delivery system, as well as YouTube, Jeff Barton, the Mortgage Voice. You can go to Jeff Barton. Let's see, themortgagevoice.com is great. We're on a number of different podcasts, as we talked about. Podclips.io is one of them. If you go there, you can centralize your podcasting needs. All kinds of different podcasts. One place, great place to go. I'm there, that's for sure. And there are a number, as I say, lifestyle, sports, financial, arbitration, all kinds of different things there. Really interesting. And it's one place, one-stop shop. So go there, podclips.io. Enjoy yourself. And again, I'm Jeff Barton. This is The Mortgage Voice. Let's get right to a little bit more of what's happening in the mortgage news. Gas and shelter, housing and rentals accounted for 60% of the rise in inflation this month. As we all know, inflation ticked up about 0.1%. That doesn't seem like a lot, right? But if you're looking at 3.2 to 3.3 inflation for the year, that's a big deal. I mean, you're talking trillions of dollars, and everybody's involved with it. If you're talking ticking up that much on a monthly basis, 1.5% per year, that's a lot. And especially if it's, as I said, in shelter, which has been going up. Now we call it shelter. We change the names of things, and we try to be as correct as possible by not offending people. And I'm all for that. I really am. But if they could just stick to one thing, that'd be awesome. Anyway, shelter is how they call housing or rentals, or however you're existing, wherever you're living, that is what they call shelter. It's kind of one of the base needs. That continues to climb, continues to go up, has been going up since the beginning of the pandemic in 2020. I remember when we talked about this, 3-4 years ago, we talked about how rentals were, going up at, 15, 20% a year in some cities, certainly San Francisco, Los Angeles, New York, some of the areas in San Bernardino and Riverside counties, whether it's Rancho or Riverside itself, rents did go up because what we found was that people needed to live somewhere, and the scarcity of housing really hit a crunch, especially when people had to stay home. And during the pandemic, that's exactly what people do. Now there's a huge mandate to get everybody out of their house and back to where they were working before. One of the main issues to that is commercial real estate. Commercial real estate in the U.S. is not doing well. I don't know if you've heard or you keep up with it, but most major cities, any major city that has any office building square footage amassed of any size will tell you that they're looking at 40 to 60% vacancy rates and have been there and possibly will be there in the future. So it's no wonder that the landlords went to the tenants and said, hey, we need your people back here. We'll give you a break on rent. We'll give you some incentives to get them back so that we can continue to get rent from you. And that is really hurting. As a matter of fact, Jerome Powell, who is, of course, head of the Fed, said last week that we were probably going to see some bank failures this year as a result of the economic downturn in the commercial building space. Not good at all. But, as bad as it can be here, it is not systemic. It is not widespread. That particular it's not a niche, but that particular segment of the market is really about regional banks. Regional banks went heavy into commercial lending, and they do that because it's easier to lend $1 billion to one person than lend $1 billion to 1,000 people. It just is. It's cheaper to do in the long run. There's more profit margin behind it. And usually these types of tenants are good as gold. Well, they're not good as gold if they don't have tenants. One of the reasons that there was a problem was because people got used to working from home. And they said, why are we paying overhead? I know as a company owner, in the mortgage space myself, I had an office and have had an office for 20, 25 years. But we went away from that model during the last recession, the Great Recession in 2008, 2009. We just said, you know what, this overhead is killing us. So let's just send everybody home. They're independent contractors anyway. A lot of major companies can't do that and have to have people in a big room or in an office building, not only to foster collegiality, but if you need something from someone right now, you just call them up on the phone and call them upstairs or call them downstairs or get them to wherever you need them in the building. Well, that's not happening now, and that's why one of the reasons when we talk about commercial, when we talk about office space in general, that we bring up the Fed chair's comments, and they're not great, right? And obviously, banks going under are not great for anybody, and these are, as I said, commercial real estate regional banks. However, it's not like what's happening over in China, and we talk Chinese investments, Chinese property market, and Chinese distressed markets all the time. And usually we do that not because we're gleefully happy that that particular country is having difficulties, because let's face it, China and the United States lead the world in many, many categories economically. Without one, the other cannot exist. We are codependent on one another in terms of making products, shipping raw materials, and selling end products to consumers both in China and in the U.S. Now, we've had trade wars galore since President Trump instituted them, and President Biden has also continued them and also expanded them. And we look to expand the chip I wouldn't call it chip wars, but what they are is they're forbidding companies from selling certain products to China with a certain chip in it, meaning that you have to buy American chips, and that's one of the reasons that the CHIP Act was so popular, the $50 billion investment in the U.S. chip-making capacity. However, I digress just a little bit. A couple things going on in development in China. One of the issues with Country Garden or Evergrande, but Vanke, another state-owned, actually the biggest state-owned entity in China doing mortgages and developing. Most of the companies were private companies, so when they defaulted on their dollar bonds, their foreign dollar bonds, it didn't really hurt the the Chinese economy in general. However, Vanke is state-owned, or at least a large part of it is state-owned, and therefore, if Vanke goes under, so does the municipality, so does the region, so does the people who are financing it, which would be a regional banking situation. However, it is endemic in the Chinese system that local economies, local governments, local entities, whether it's on the county, city, or town basis, they invest in commercial development. It was booming for 20 years. Why not? Well, it's not anymore because, as I said, the party was over and the investment in that sector has ended from the central Chinese government. And so a lot of these projects from Vanke was actually, let me read it here. Let's see. It is asked for an extension on $650 billion in debt because this was one of the largest developers by sales. They were actually the second largest developer by sales in China, and currently asking for a $650 billion debt extension in order to be able to see if they can prop sales and get back into the green, which they reckon, or the black, which they currently are not. Ni Hong, which is one of the Chinese officials in charge of this particular sector, country will not bail out distressed property developers. Okay, that came from one of the chief heads. His name is, and I'll butcher this name, and I apologize. Ni Hong, H-O-U-N-G, has said that, and I read that on where is it? Either Housing Wire or Bloomberg or one of the great websites that comes out with this. Now, we don't get a ton of information or reporting on China other than what's happening in the property sector. But we know darn well that this sector has about 25% to 30% of the entire Chinese economy. If this goes bad, it will be systemic, and that could affect world economies. We are talking about, obviously a lot of different things when we talk about how it affects you, how it affects your mortgage. Certainly if we have a worldwide downturn because Chinese development and they've stopped buying U.S. goods, we would probably have a ripple effect here of layoffs and a number of other things. So that's why we follow it, and that's why one of the reasons why what we're experiencing here in the U.S. in the commercial property sector in most major cities in downtown is similar to, but not the same as, what's going on in China with their real estate property housing developments. Both economies need both kinds of sectors in order to be able to continue growth in China, most particularly because for 20 years, as I said, that has been the major engine for growth in that developed country. Okay, so let's see, what else do we have here? Four most overvalued real estate markets nationwide. They say and this I got off Housing Wire, 11.1% is where they see that the actual housing market is overvalued. That's nationally. But the four major markets that are overvalued the most: Memphis, Buffalo, Milwaukee, and Indianapolis, all heart of the country type places. And if you live in those places, I'm sorry to say, but that's what they're saying over at Housing Wire. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us, trying to sort through what we're saying to get your decision-making processes a little bit clearer, a little bit easier on you. We've talked somewhat globally today, and I apologize about that, but we always try to get the best information about decision-making processes. Sometimes those decisions that you make are based on exactly what you see in front of you, and sometimes they're not. Sometimes you can't see what's coming around the corner. That's what we're here for, and that's why we try to guide you into a situation where you're going to get the best, not only the best rate, but the best loan program available for you. Might not always be the best rate, but it might be the best way to get that property today. So we always do that, and really the person that describes this the best here is Charles Giscombe, who joins us from United Security Financial. Once again, Charles, how are you?
Great, Jeff. Thanks for having me, man.
Thank you, and thanks very much for coming on. I appreciate it. I know you've been a busy guy. Tell us a little bit about what's happening in the market out there.
I mean, at the end of the day, Jeff, people are still transacting. You obviously have some nervousness, obviously with this when elections are coming up.
Yep.
So, stock market as well as, obviously LIBOR, the different situations, they fluctuate some. But for the most part, people are still transacting. Interest rates are they're going up and down a little bit higher. They'll come back down, as most of us know, and we just need to wait for that to happen. In the interim, what I'm telling my clients and what we're doing is we're creating short-term and long-term strategy goals. Short-term is just to get the acquisition done, to get us through the door with the path of least resistance. Long term is to make sure that when it's time to transact, when those interest rates do get lower, that we have no prepayment penalties or very short ones, so that we can automatically go into our long-term strategy, which is locking down a low interest rate loan for 30 years or more.
Now, Charles, do you have a lot of clients going from a low-price mortgage, selling that property and getting into something else, or is it still a lockup situation with your client base?
You know what? I have some. Recently, I've had a lot of investor clients that are coming to the table,
Okay.
Looking to transact. Some of them have their mortgages or their properties are so profitable that they're looking to do refinances and pull cash out.
Okay.
They know that the interest rates will go down, so they're just going to use their cash to buy other properties. I'm finding a lot more people interested in buying the Airbnb, variable type short-term rental properties. They feel that those are working well as commercial properties are doing well, especially the programs that we have to get them in. A lot of the programs are path to least resistance programs, which these people are very interested in. And surprisingly, a lot of business people have never heard of these loans or don't know that they're available right now, Jeff.
Okay. Now, that's very interesting. I know that in the commercial property sector right now, we have a lot of vacancies. Maybe some regional banks, according to the Fed chairman, are going to fail this year. Are there any signs of that where you are, and are investors obviously sniffing around for a good deal?
Yeah, what we're realizing is that traditional banks are not providing the financing.
Right.
They're looking for individuals like us who have private lenders, equity, hedge funds, different people that have a certain, in their will, they're comfortable with a certain type of loan. That's who's loaning money out. And also, I have seen a big increase in the lending from credit unions. Certain credit unions locally have the ability to provide certain loan products that traditional banks would not be able to provide or will provide. They're just trying to enhance their portfolio for their clients so that they can, kind of tap in where they weren't, where they're not able to get a big stronghold. They have some niche products that they'll allow to get done. And so credit unions have been doing a great job. There's some credit unions out there that are offering some really good, business, commercial programs, as well as some personal home equity lines of credit and things of that nature, Jeff.
Oh, that's interesting. We used to do a bunch of business with Connecticut Credit Union. I think they were with the teachers. And we did, obviously, TCREF. We did that for a long time. But I thought they got out of the business. You're saying that, no, that's not true. They're actually back in the business in a strong way.
Well, there's some credit unions that are offering some really, some dynamic programs, and maybe it's just, the type of the money that they're getting or where they're getting it from. Maybe the groups are more comfortable in that. But I'm seeing some credit unions offering some stuff. And I'm also seeing some investment type of standalone HELOCs on investment properties, second properties, and investment properties being able to provide standalone seconds, which is very interesting,
right?
Because usually that usually only be afforded to primary residences, Jeff.
Oh, that's very interesting too. Second position on a commercial loan is never an enviable place to be, but if it's you got a secure business building rather with a lot of equity in it, I guess that's a good way to do some lending. Who's doing it? Major banks, or as you said, smaller individual type institutions?
It's been some smaller banks. Chris Pryor at Searchlight Malibu and Searchlight has some interesting companies that are offering these type of, I can't think of them off the top of my head. We're just introduced to them. We had a great meeting, and there were some banks that were saying, hey, yeah, we will deal with commercial seconds, standalone seconds on commercial property, investment property, fix and flip properties, or rental properties, which is a great place to be. There's a lot of people, Jeff, that have equity in these properties that they've picked up and flipped. But they didn't realize or didn't know that there were banks that would allow them to. They thought they could only get this money off of their primary residence as far as HELOCs are concerned. But no, on the contrary, there are banks out there that are definitely offering second position loans on investment properties, allowing you to tap into that equity piece because they want you to transact again. They want you to get back out. And they're hoping that if they offer that product to you, maybe you'll look at some other stuff that they have, too, to get some more business from.
Other than money down and programs, we talk a lot about appraisals, of course, the value of the building, and credit scores. These are two things that are either easier or harder when it comes to underwriting a loan. What have you seen so far this year as opposed to last year?
In regards to credit,
Yep.
I'm seeing people be more lenient. What
Okay.
we're realizing is that if we want people to transact more in this particular market when interest rates are higher, so what we're going to have to do is we're going to have to maybe lower the credit grade a little bit to allow other individuals in. There's a lot of individuals, Jeff, that have lower credit scores but still meet the criteria of a traditional mortgage, let alone any other type of mortgage.
Right.
So if you just lower that for whatever it is, they might be a little debt heavy. They might have had some credit events that occurred years ago that's keeping their scores down. And there might be that they just don't have enough credit, and there's things that we can do to help them out with that too. But now I'm seeing a lot of the lending situations say, hey, listen, we're going to lower. Like before where it was a 640, and it was a 620. I have some banks now, Jeff, that are saying we'll take a 570 or a 550 credit score.
Wow.
And we'll get you in there if you can provide the other documentation that you need. Now, obviously, your compensating factors need to be a little bit stronger, or you have to have more stuff. But they are still lending to individuals with FICO scores below a 600. And we can do that at United Security Financial, and I know for sure Malibu Funding can provide that. Also, with appraisals, I'm seeing other companies with the appraisals, they're now who weren't taking transfer appraisals, who are saying, hey, listen, we'll take a transfer appraisal. They're allowing you to rebuttal more on this because there's been some mishap in values, just give you an opportunity to get in. And then also there's some loans, investment property-wise, that they'll just do desktop appraisals, Jeff. They won't necessarily do a full appraisal. They'll do desktop appraisals based upon the comparables and the different things that have occurred in that particular neighborhood for sales that are recent. So I'm seeing different things occur, but I feel like they know that they need to do more. We need to do more in order for people to continuously transact. So they're going to allow certain things, give certain graces, lower credit report card grades so that individuals can transact.
Oh, that's a great answer on both accounts. Obviously, it sounds like it's a little looser, a little easier. Credit scores may be a little forgiven. Might cost you a little bit more, but you will be able to, as you say, transact.
Well, I always say, Jeff, how bad can the interest rates get now?
Right.
If your credit score, if your credit score is a little bad, no. Hey, listen, a person with a 750 score and a person with a 570 score, neither one of them want to be in the interest rate that they're going to get.
Right.
So at the end of the day, it's about the acquisition. When you have the acquisition, when you own the property, you now have leverage. Now you have the ability to go in, look at your equity position, see where you are, and like Jeff said, it's a great transition in. Now you have more opportunity because even on refinances, even on home equity loans, they're lowering the standards or the guidelines so that other individuals who may not have the best credit are allowed to get them into the game so that they can start transacting as well. Basically, all it is we need the economy to keep moving. The more people we let in, the more transactions happen, the more money moves still, and that will help us along the way until we get back to where we were with the lower interest rates.
Excellent answer. Chuck, thank you very much for coming on the show once again. You're always illuminating, and I always appreciate the interest.
Jeff, thank you so much for having me, man.
No problem. That's Charles Giscombe for United Security Financial. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.